Hello, everybody, and welcome to the 2022 second quarter webinar we're having today. My name is Josh Stirling, and I'll be your moderator today. Today, we're going to have our webinar be about 20 minutes of presentation with prepared commentary. And then at the end, we're going to have about 10 to 15 minutes for Q&A. For those who have not done a Zoom webinar before, at the bottom of your screen, you're going to find a Q&A button. Feel free to go ahead and click on that, submit any questions that you might have, and we'll address those at the end of our conversation today. Also, the topics that we're going to cover today. First, we're going to hit the economy and what's been happening in the economy over the last quarter or two. Then we're going to talk about the turmoil that's been happening in the market recently. And then we'll talk about how those facts impact you and what they've been doing to your portfolios. So first, we'll jump in. For those who might be new to Klaas Financial, just to give a little history. So we've been in the business now for a little over 45 years. We have 2 office locations. Let's jump ahead here. We have 1 office in Rockford, Illinois, and then we have another office in Madison, Wisconsin. Even though we only have 2 offices, we do help clients across 30 states, all across America. We help over 1,000 households in America, and we have 22 employees that are dedicated to delivering quality financial servicing and helping invest for retirement. So today, I'm joined by 2 individuals, Eric Schwartz.
Hey Josh, how's it going?
Very good. Thank you for coming. And then I have Todd Eklund.
Good to be here again. Thanks everyone for joining us on such a nice warm summer day.
So as you all know, we like to have 2 different people joined in who are from separate divisions within our company. We have them join in to give different viewpoints and have people that are a little bit more knowledgeable on the investment side. So Todd is our director of portfolio management. And then Eric is one of our lead financial advisors, a part of our advisory group. So let's not waste any time. Let's jump right into it. Todd, what are your thoughts on what's been happening in the economy?
Well, speaking of history, Josh, you mentioned on the introduction to Klaas Financial, we've been in business 45 years. If we go back in time, just about 30 is around the last time that we had an environment like today with what's going on in the economy and inflation and interest rates. And so it reminds us of 1994. And I say that because we're on the precipice of a possible worry of recession. The economy has been weaker and inflation is high. And so the last time that we were worried that interest rates were going to get hiked too fast and we'd dip into a recession was around 1994. It was right when Bill Clinton had been elected president. So it's been some time, and we're sitting here today with a lot of uncertainty. But the good news in all of this is that we didn't go into a recession in 1994. And if we fast forward to today, we're not going to know actually for another month or so, if I'm not mistaken, if we fall into a recession. And that's defined as 2 consecutive quarters of negative GDP growth. But the good news is if we look back to 1994, when the Federal Reserve did hike interest rates, it can work as the medicine for this. Eric, you have any thoughts?
Yeah, I think what I would probably add is generally people forget that recessions are, while painful, they're part of a normal business cycle. So a recession is not a sure sign of economic issues, right? As we talk about this, I think people a lot of times will go back to 2008, 2009 as, the example of what a recession is. And I think it's important to remember the magnitude is different for each and every recession. And from the planning side of things, as we've talked about before, we do not assume that the market's always going to be rosy and we're going to get great returns in planning for your retirement. We test for situations just like this. So while I know turning on the TV and looking at your statements can be a little bit unsettling, just important to keep kind of the long-term perspective in mind.
Mm-hmm. Well, let's not dance around it too much. Let's talk about the fact that's been driving a lot of this conversation.
Yeah.
Todd, where are we now with inflation?
Well, you said it well, Josh. I mean, what's been driving all this? What is the core issue? Inflation is high. It clocked in again at 9.1% last month. It's been high for a while now. And so there was a time when we thought this would just be transitory, temporary, but it doesn't seem that it's going to self-correct. And we're seeing high inflation across really all types of items, not just gas, or food. It's really everywhere. And so that is what the Federal Reserve is hiking interest rates for, is to try and slow down that high rate of inflation, slow down the economy. When an economy grows fast, inflation grows fast, and when it slows down, inflation slows down. What we're hoping is that we don't get stuck in slow growth, high inflation.
Right. And I mean, we're definitely hearing from clients asking for our opinions on which way we think has inflation peaked, where are we in that process. We are not in the prediction game here at Klaas Financial. It's a dangerous game. We are seeing some signs of relief. The gas pump's been a little friendlier to us recently, but we're not putting all of our eggs in the basket of we've peaked and it's all rosy from here.
I think one thing that we often look towards is what's the Fed doing about it and how that's impacting the markets. So I know that we've all been hearing a lot about interest rate hikes over the last couple of quarters, and they've been scaling up quite a bit recently. So I think we all know what that is like, and we're going to have future announcements of interest rates coming up even more. But Eric, can you talk about some of the biggest repercussions we've been seeing from the Fed's actions of raising interest rates?
Yeah, and I think Todd had a really good explanation of this. It's, the Fed is raising interest rates in an effort to cool down the economy, right? They're trying to make borrowing more expensive for consumers and for businesses to, I said, just kind of put the brakes on things a little bit. And one area that we see really impacted by this is buying a home. So in the last 2.5, 3 years, we have seen incredible increases in the price of homes. The median home sold in the United States as of the end of June was $428,000. And what has happened is basically cheap money, low interest rates, right? And a general kind of lack of inventory, because building is so expensive, has really driven prices up, and we've seen demand just skyrocket
Across the whole country, I would add. It hasn't just
Absolutely.
been a few hot markets.
Yeah, and that's important to remember. I mean, every market is a little bit different, but in general, we've seen this growth, and as the Fed raises interest rates, that raises the cost of ownership. And unfortunately, fortunately and unfortunately, that is by design. And what we're seeing, we'll look here at an example. What we're seeing though is as affordability becomes more of an issue, we're seeing fewer offers. We're seeing asking prices come down just a bit. So to Todd's point earlier, I mean, it seems to be working.
Just as a clarification, this demonstration here in front of us is how big of a mortgage?
Yeah, so this is actually looking at the cost of buying that median home, that $428,000 sale price, and assuming you put 20% down and you're financing 80% of it. If we start here on the left in December, the principal and interest was coming out at less than $1,500 a month. If we go to June, I mean, just with rates coming up, it's up over $500.
6 months. Yeah.
Yeah, and that's adding more than a third to the price. So you can imagine, as people are looking to buy homes and they're seeing what their monthly payment is going to be, it has a lot of people rethinking whether or not now is a time that they can actually afford to buy a home. And it's just leading to those, fewer offers on homes, fewer bidding wars, driving up prices even more. So whether or not it's enough to really slow down the inflation we've been looking at, it seems to be working to some extent.
It really seems though that people that are avoiding this are almost the people that have homes that don't have mortgages.
Eric, now you bought a year and a half ago, right? So you got into the bond.
I did get in. Yes, that's true. But we've seen for the last, 12, 13 years, I mean, just very, very low interest rates since the financial crisis. And I think as rates come up, it's really unsettling for people looking at these increases. But what I think it's important to put things into perspective. We love to say that at Klaas, let's make sure we keep the right perspective. if we look back 50 years and we look at the 30-year interest rate on a mortgage, I mean, we're still below that 50-year average. You know, today we're looking at somewhere in the range of 5.5 or 6% on a 30-year. The 50-year average is 7.7%. And I know, talking to clients, Todd, they tell me stories of having mortgages at 15% and higher. So, you know, while it's still an increase over where we've been, there is perhaps an argument to be made that we're coming back to maybe a more normal level.
Certainly. And I would just say, you know, for people that plan to stay in place and not move around, you know, whether you're paying 4% or 7%, does it really matter? If hopefully you can afford it, you're going to stay there and be able to wait it out over time.
Yeah, I think for existing homeowners, something that we're talking to people a lot about is, because rates have been so low, it's been really attractive to borrow against your home for expenses. And a lot of people will have home equity loans, which, you know, for a lot of people has been a great way to access some cheap money. But as rates come up, this is as good a time as any to look at cleaning up your balance sheet and maybe making a little bit larger payment on that home equity loan, because rates on home equity loans are going to be impacted by the Fed raising rates. So it's definitely something that we're seeing largely impacting the housing market, but it is still going to hit people that have a home and maybe have tapped into it for some cash.
Yeah, this definitely seems painful for people who are kind of forced to work with the mortgages in this time. It's not the most ideal situation, but let's go ahead and shift our discussion from a little bit more from the economic side of things, and let's shift to the markets, because of course we've been in a rough couple of quarters here. So Todd, I've been hearing in the news a lot about different indices, and you continuously hear about new lows or certain indices just hitting negative 30% on the year. Can you tell us more about those indices and maybe how they compare to our portfolios?
Sure. You know, I guess depending on the day you're watching the news, are we in a bear market or are we not, right? But there's no way around it. It's been a really rough year in the markets, and frankly, even over the past month into July, we just seem to bounce up and down. So there doesn't seem to be, you know, relief on the near-term horizon. The NASDAQ, which is very heavy with technology stocks, these are a lot of the companies you're reading about in the news. You know, it's down significantly this year, you know, near 20% at mid-year. There's a reason why we do invest the way we do, and don't just invest in an index like the S&P 500 or even the NASDAQ, for instance. So if you look here on the screen, you know, the damage isn't quite as bad in a 60-40 globally diversified portfolio. And we would expect that if things got worse, hopefully, you know, that ballast will continue to be there. But when you spread out your assets across different types of companies, different countries, different size companies, both small and large, there's a real benefit, and that's why we believe that's the best way to invest. And it's interesting on the flip side of it, if you were to go back a year and a half ago, coming out of COVID, it was probably easy to feel like I'm missing out by not being in the high flying NASDAQ, right? But this is where that discipline of being in a diversified, balanced portfolio really, you know, plays out.
It's always easy on the way up, but really difficult to hold true to your plan on the way down, unfortunately.
The one thing I would add with this year that's made it rough, and we'll expand on this in a moment, is that it's been a really tough year for bonds. So a 60-40 balance global was down, you know, at mid-year about 14-15%, give or take, depending on your reference point. And Absolutely. You know, in the past, when we've had down markets, your bonds have generally tended to go up because interest rates had moved the other way. So this is a unique environment. We'll see how it plays out, but we still expect that discipline of diversification to be a significant benefit.
Yeah, traditionally in kind of down markets that we see like this, we wouldn't see that global 60-40 portfolio being down quite as much as some of these major indices that are hit pretty hard. But I guess with the reality of what's happening to the bond market nowadays, do you think that the bond market can ever catch back up from what happened?
Yes, patience is a virtue, right? Is that the expression? What we're looking at here on the screen is the starting level of interest rates and then the return for bonds over the subsequent 10 years. So not immediately, but over the subsequent next coming decade. So the problem is when you get whacked, it's going to be good for you eventually, but it takes some time, and that's really where we're at with bonds. So the good news is that from where we are today as a starting level of interest rates, we would expect that over the next 10 years, generally, that means bonds are going to give you a much, much higher return than you've been accustomed to previously, or when the starting level rate was low to begin with. The bad news is that you had to, kind of take a punch to the stomach first with the losses. But the big question mark in all this, going back to it, is inflation. Getting 10% return on your bonds really won't matter all that much if inflation is 10%, right? And so that's really the big question mark today.
Mm-hmm. Yeah, and I think that's one of the downsides of the long-term lower interest rate environment we've been in, is we're kind of starting from the wrong end here as we're facing this inflation. So as we look back, I think this is a really interesting graph just to get some perspective, because as you said, patience is the most important part. And when you're looking at your more conservative portion of the portfolio, going down in the first part of the year here, it can be hard to stay patient. But
absolutely, I think looking back this far and just seeing how those interest rates rise, and you see a little bit of a delay between that and what the subsequent return over that decade is it's powerful. It's helpful to look at what happens in reality over time, but in the moment it can be really hard. So we want to spend a few minutes here at the end to talk about the reality of the situation. We recognize that these times aren't easy, especially when we're looking at 6 months of the market going down. Everybody now is opening up their statements and they're looking at what happened in June. And to be honest, June was not the best month. We saw a lot of bear market headlines come out, and those moments can be terrifying. They're not good to go through. But here at Klaas, you've heard it before. One of our mantras is stick it out, you have a plan, and move forward with it. But I know that every time we come into one of these, it feels different. And this time definitely feels different. Todd talked about it earlier about how supply chain is out of whack. Inflation is really high, and we haven't seen this since the 1980s. And it's going to be interesting to see how we come out of it with the response from the Fed, with how the supply chain is going to react. And it's going to take time. It's not going to solve itself overnight. But whenever we have these unique situations, it's important to listen to the words of Mark Twain. History doesn't repeat itself, but it rhymes. And that just means that we'll eventually get through it. When we look at the history of what's happened over the last, we have 22 and a half years on here, starting in the year 2000. And you can see just some of these different events that have popped up over time. You have the dot-com bubble, the Great Recession. During that time, the stock market's lost decade, where the S&P 500 didn't have high earnings at all, and it just felt like we were dragging along the entire time. But then you push out a little closer to today, you have the pandemic, and of course you've had what's happened over the last 6 months. But even with all that happening, I know it's a long time frame that we're looking at, 22 and a half years, but we're looking at an investment that started at 250,000. It grew all the way to end of last month to 751,000.
Patience really is a virtue.
That's 3 times the value over that period of time. And we're using the global 60-40 portfolio, our most commonly used portfolio here at Klaas. And I do have to mention that it in this projection here, it did peak at 900,000 end of last year, which is really powerful. But that does mean that we dropped about 150,000 in a period of 6 months, which can hurt. But when we look at the types of investing, the types of investors that are out there, I'll simplify it down to two. One person that has a plan, a financial plan that they stick to, and one person that doesn't. And the person that has a plan should know that they're controlling what they're able to control. They're impacting things that are within their wheelhouse to impact. And when these moments of fear and frustration come into play, you know that you can rely on your plan as being the way to have success in your goals. But somebody who doesn't have a plan is sitting in a much different boat. they're sitting there wondering what's going to happen, if we're going to be able to get out of this, if they're going to be financially secure in retirement. It could be a hard reality to live in. But if you ever have fears like that, you always have an advisor here to be able to help you. We have dedicated financial teams, making sure that you feel comfortable and that what you can control is being controlled. But Eric and Todd, you have any thoughts on that as well?
I would just echo what Josh is kind of saying here. I know we come every quarter and every time you come in for your review, and it feels like we're always saying the same thing. You need to, stay the course, don't make big changes in response to the market moving. And we recognize that can feel maybe a little unsatisfying. Maybe it feels a little frustrating, because when things are volatile, it feels good to feel like you're doing something, right? To be like you're doing something. Exactly. And the reason that we are always telling you not to is specifically the graph we were just looking at. History has taught us that the best thing we can do in times of volatility is stay the course. We build financial plans around our investment portfolios. We don't just invest for you. So the biggest thing that I can really just encourage all of our viewers here is stay calm. We have planned for times like this. We did not assume, as I said earlier, that the market would give us incredible returns every year, because that's just not anything we can control. And we've built your financial plans and your investment portfolio to be able to go through times like this.
Mm-hmm. So with that, I think it would be an appropriate time to jump into some Q&A here.
All right, my favorite part.
So as a reminder, at the bottom of your screen, you do have a Q&A option to be able to submit some questions. So feel free to enter those in. We did have a handful of questions come in via email before we started the webinar. So this first one is exactly in relation to what we just talked about here, but it's an email we received a couple of days ago. So looking at the current market status, it seems as though we are going to be entrenched in this downward trend for some time. Should we be moving our money or reallocating it to something else other than stocks? What would be a better alternative? And I think at this time, it's important to recognize that it's not just about sticking to the plan, but also it's always important to reevaluate. One of the moments in time that we say is the appropriate time to actually make changes is when something changes in your life. And so if anything has changed in your life, definitely reach out to your financial planning team and they'll be able to assist. But I mean, Eric and Todd, thoughts on getting out of stocks right now?
I mean, this harkens back to what you said. We always say that investing is not about a light switch, be in the market, be out of the market, or be in bonds, or be out of bonds. It's truly a good gray area that you hold both and give yourself enough time. So the good news about today is that interest rates are higher, and that means looking ahead, you should get higher returns out of that fixed income or even out of the cash. And we have a couple of specific questions on that in a moment about cash in your bank account. But there isn't anywhere else to sort of reallocate, or this is the attractive place to be today. It's really about recognizing what you need to accomplish over what time horizon and what type of portfolio is appropriate to be that vehicle to get you there. And really that comes down to just the overall mix of stocks and bonds rather than, am I in or am I out?
Mm-hmm. Yeah, I really think Josh nailed it in saying, if something has changed in your life, then I think there's a conversation to be had around your allocation. But for the vast majority of folks we work with, the only thing that's changed is the market has gotten volatile. So as you come in for your reviews, you're going to see us and we'll talk through all of these things. But in general, the short answer is no. We would like people to stay put.
Mm-hmm. So let's go ahead and move on to one of those questions that Todd, you were talking about. What should I do with my extra cash savings? And I would assume that this is somebody who has an emergency reserve already set up, already stabilized, and maybe they have a little extra cash on hand that they weren't planning on using for anything.
Sure, well, I'll take a crack. For the longest time, we spent a decade with these low interest rates, and things like a savings account outside of your checking account or or a CD, various CDs were just zilch, right? There was no reason to even have them. That certainly it changed today. You're getting a higher rate of return in some of those other instruments, like a high yield, savings account. So it could be attractive, although it all comes back to, is getting a 2 or 3% return there. If it gets that high, is that any better than 9% inflation? And so that's an important element to keep in mind as you think about those things. Everybody should probably have a little bit of a reserve bucket somewhere, but I don't know that the environment has changed, that you should be putting more or less to that sort of emergency reserve bucket just because the interest rate environment has gotten different. Yeah, Eric?
Yeah, no, I think what we're looking at here is if as rates come up, there are actually opportunities for the first time in a while to get a little bit better yield if you are if you're actually doing a little bit of research up front and actually looking for a high yield savings or money market account. So I think there are opportunities out there now, but in terms of doing anything different with your emergency reserve, other than something that's still going to be FDIC insured, I wouldn't recommend that.
Yep.
Generally to our clients.
So I have another question that came in here, and I do have to preface this that we are not necessarily experts on this topic, but I think that we can kind of talk a little bit about
play one on TV, right?
Yeah. So what does it look like for new construction cost over the next year? And I think one of the big things that I've heard about is that new construction mortgages and financing can be really volatile when you don't know what the interest rate is going to be in the future.
Or I would add maybe some of the component inputs. If you go back a year and a half, lumber prices were up quite a bit during COVID. To the extent that those stabilize, I think it probably depends. A lot of this is we've been saying for a year and a half, right? Like hopefully this is just supply chain oriented and it's going to come down, and we keep waiting on it too. So if that's been something that held you back, it's hard to forecast. And Josh, the interest rate component as well.
Mm-hmm. Especially as it's shifting and we're seeing interest rates potentially rising in the future. It could be difficult, and it can increase costs when you're not necessarily ready or prepared for it. Eric, have you heard a lot about your clients looking to build new homes or dealing with any concerns like that?
Well, I think it really comes back to the supply chain issues we're having. As we've waited for them to come down, I think it was under the assumption that the supply chain would be in a better spot than it was a year ago.
Keep coming.
And I think we're still waiting on that. So I think the logic behind it of these higher costs being in many ways related to hopefully temporary issues, I think that still holds true. And unfortunately, I think as rates rise and we have that sort of come into play, the decision becomes even harder if you're thinking about building, but kind of holding off at this time.
I guess it depends on what you're building too. I'm not, but are you ordering granite from somewhere else overseas, or does all those things come into play to your unique situation?
Mm-hmm. So let's move on to a question that focuses a bit more on the clients who are in retirement, the people who might not have as much equity exposure. So I think this is a great question because it's nails it right in the head. So many of our comments seem to address the active account builders, those who have a lot of equity in it. Exactly what are we doing to address the bleeding for the rest of us who are in spend down mode? And I think it's a reality of where the fixed income market is. And from my viewpoint, I view it as kind of like a double-edged sword. As interest rates make movements, you're going to see movements in your account. And unfortunately, right now, interest rates have risen a lot. And so we've seen bonds take a bit of a hit. But that also does mean that income is rising as well. So as we spend more time, one of the graphs that we looked at recently talked about how bonds eventually will earn positive returns and make a positive impact in your portfolio. And so that's something to keep in mind, is even though your bonds have taken a hit throughout the last 6 months, that interest rate rising will pay you more in the long run.
Well, moving away from just the financing part of it, Eric, what are the levers that somebody in retirement who's in a fairly conservative portfolio, maybe they have 30% stocks or only 40% stocks, what are the levers they can pull in a market like this that have nothing to do with the returns they're getting to adjust for either high inflation or just a stretch of a few years, right, where the markets don't give them a rising tide of returns?
Yeah. Yeah, I think this goes back to the planning that we do. And I don't mean that as like a cop-out answer. I think as we're looking at allowing people to retire and begin taking distributions out of their accounts, we are setting up a distribution that is sustainable through stretches of markets not giving us the types of returns that we'd hope. So I think that as we look at being in this last 6-7 months of the market coming down, we are not expecting that a lot of our clients are going to need to make significant changes just because the market's going down. That's why we build out what we call a sustainable withdrawal rate. Now, some of the things people can do and that we have been talking to people about is if we have clients that have been putting off taking Social Security and it's an option within their financial plan to consider starting that a little bit earlier than planned. I think that can help a lot of people who right now just can't really stomach the idea of continuing to take money out of their accounts while they're down. I can sit here all day long and tell you that our math says you'll still be okay, but it still isn't fun to watch distributions come out of a portfolio that's coming down. So that's just an example of one thing we've been talking to people about, and again, it'll be something that we address in your upcoming reviews. But I think it just comes back to the idea that we build financial plans to be sustainable through times like this. So yes, the market has not been giving us positive returns, but in our view, that doesn't mean that we need to make significant changes immediately to your financial plan.
Yeah, it's been a few years since I've done significant financial planning, but I recall that another important source of income in retirement is Social Security. And we've seen Social Security respond to some of the inflationary hikes that we've experienced. And I can't recall when the next kind of cost of living adjustment is going to be made on that. But knowing that there's responses in other areas where you're receiving income, it is really good to know that you're going to have sources where you're not going to have drops in income, but you'll have increases in income to help match what reality we've been dealing with. All right. So moving on to the next question here. Another great question about bonds. I've heard about recent government bonds paying over 9% interest.
What are those called?
Is this a good time to use reserve cash for this purchase?
Yeah, so this is discussion is, well, I think what our question is referencing here is I bonds. I don't know a lot of other government bonds that pay over 9% interest. But as we look at the interest rate environment, there's certainly nothing out there paying 9% even as interest rates come up. So I bonds do become more attractive. The one thing to keep in mind is there is a limit to the amount that you can put in on an annual basis, but they are a really attractive option right now, especially if you have some excess cash, because there can be an interest penalty if you don't hold them long enough. So obviously talk to us before making a big investment in that, unless you have a whole bunch of extra cash that you're looking for something to do with. Yeah. But they can be a great option for many of our clients.
As I understand it, it's sort of a sweetener, right? In a sense, because there's that limit on how much you can put in. I think depending on where you're at in your circumstance, the relative attractiveness of it as a sort of excess reserve to get that return probably diminishes, given it might move the needle for you less and less with that cap relative to just understanding, what you could get out of a long-term portfolio too over the holding period.
Yeah, absolutely. And I think it's important to understand it's not as if your money is locked up and you can't access it for a certain period of time. But just if you think of taking your principal out of a CD early, there are interest penalties and things like that. So nothing that would I think deter people from using them. I still think I bonds are an incredible opportunity with inflation so high. To have a bond, a fixed income vehicle that's linked to inflation during a time of high inflation. I think that's really attractive for a lot of our clients.
We just wanted to reiterate that we recognize that this is a fairly hard time to be going through right now. We know it's not easy taking a look at these statements. And we can't necessarily address every single question that comes in to the fullest ability without knowing your personal financial plan. So we try to answer these as well as we can in giving general guidance and advice, but your financial planner and planning team are the ones that know you best. And so if you do have specific questions or you think your circumstances have changed and things should be reevaluated, please reach out to your team. We are more than happy to look at anything with you. So with that, we thank you for joining and spending time with us on a sunny afternoon. We will be back next quarter and we look forward to seeing you all again. Thank you.
All right. Thanks, everybody.